and welcome to our Diwali special Market Masters. I have with me two Market Masters. First up, we will be speaking to Neelkanth Mishra, who is the Chief Economist, Axis Bank, and the Head of Global Research at Axis Capital. In a bit, we will also be speaking with Vetri Subramaniam, the Chief Investment Officer at UTI Mutual Fund. But first, Neelkanth, he strides the world of economics and stocks with equal ease. Welcome to our Diwali special, Neelkanth. Well, first up, tell our investors, our viewers, how do you think the Nifty will move in the year ahead? Elections, the 2024 elections will clear out some uncertainties. So do you see rapid new highs?
Absolutely. And I don't think elections are what we need to really worry about. I think what we need to worry about is how quickly the global issues get sorted out. I don't think they'll get sorted out for many years, but at least, you know, the current trajectory is in many ways unsustainable. We are seeing significant shortages of dollars outside the US. The US fiscal problem is much bigger than what is currently understood. And this will mean that things come to a head and then something breaks. And then the only solution is for the Fed to start buying US treasuries again. So I think that's the only thing that we need to wait for. Till then, I would remain very cautious. But the Indian economy is doing extremely well, much, much better than expected.
Okay, I'm coming to the Indian economy in just a minute, but you have just raised my curiosity a bit on your interpretation of the global backdrop. Do you think we will be, this phase will end with a financial accident? I mean, what are your thoughts? One thought that a soft landing is what we would be able to get away with.
I think the issue of a soft landing is, I think that's completely misplaced. People are not acknowledging the fact that the US fiscal deficit went up by nearly 4% of GDP, right? So people have been saying, oh, the interest rates have been high, inflation has come off, and look, everything looks hunky-dory. What's ignored, and this is why in a recent column I called it when DMs become EMs, when developed markets start having emerging market-like problems. You need emerging market analysts like us to actually show the mirror and say that, look, if your fiscal deficit expands in 1 year by 4% of GDP, how can a recession happen? And unless what was $1 trillion in FY22 became $2 trillion in FY23, unless this can become $3 trillion in FY24, and I hope not, the US is going into a recession. I don't think there is any chance of a soft landing.
Okay. Well, then what does that mean for India? Already we are seeing our services exports getting impacted. Does that take away a huge chunk of our growth as well? Software companies, already IT company results are showing that pressure.
Yes. So there are three channels of risk. Therefore, the first is, as we said, services exports start suffering because that is our primary market. Then goods exports. In fact, if you've seen oil's behavior of late, it does suggest that the markets are starting to worry about weaker global demand, and particularly in the US, because US was pretty much the only economy which was holding up. And progressively, so I just came back from 3 continent marketing where I met a large number of investors, and progressively in October, data points even in the US have actually worsened. So I think that goods demand and goods exports will worsen further. We have in Axis we have a global goods demand tracker. It is well below the pre-pandemic trend. The only country which was above its pre-pandemic trend was the US. And now that the fiscal support is not going to be there, or at least the fiscal boost will not be there. And remember that fiscal boost was coming through a sharp decline in personal income taxes. So basically, despite wages being where they are, the disposable income actually had been going up. And so as that corrects, I think global goods demand goes through another correction, and that will be another headwind for the economy. And the third channel, in my view, is the capital flow channel. If you look at M2 growth, like the broad money growth in the US, remember that the US is doing quantitative tightening. So M0, the base money growth is negative. Now bank credit growth in the US is negative as well. And this is an intended outcome. If you raise rates, of course, credit demand slows down, which means that M2 growth is even lower in terms of, which is more negative. In an economy which in September quarter, which grew at nearly 8% in nominal terms. And so the dollars availability, the availability of dollars outside the US is, I think, a significant issue. Look at what is happening to us, right?
Yes, yes.
Our net FDI has now slowed to $20 billion at a run rate. I hope it doesn't stay there. External commercial borrowings, there's no possibility of dollar funding for most of the companies. So what used to be a $15, $20 billion plus is most likely a $5 billion minus. And it will become very hard to finance even a $40, $50 billion current account deficit. So, and we are better off. We should be expecting some bond inflows in the next 12 months and all that, right? But think about Indonesia raising rates despite inflation being in control. So I think we are now reaching a stage where the US government, because of its enormous increase in fiscal deficit, is sucking in all the dollars. The Fed needs an excuse to start buying US treasuries again. And till that excuse is there, I mean, something has to break. There are many things that we can discuss and speculate, though it's very clear what exactly will break.
Okay, I get that. I get these three channels through which we are going to be impacted. But, you know, let me ask you to take away your economist hat for the moment and don your head of research hat, because ultimately the stock market investors are listening to you. What will this mean for stock markets? Are we going to see earnings downgrades, albeit by a smidge, but will we see that?
There will be some cuts, but by and large, because the Indian economy is doing so well, I think the earnings trajectory is going to be much, much better than what the market has been used to. Remember that in nearly all of the last decade, when the Nifty EPS, see, the Nifty EPS for 1 year lasts for about 30 months, in the sense that we've just seen FY26 come in, right? FY26 estimates are being published now. It will be about 30 months before FY26 becomes actual.
Yes.
In the previous decade, in these 30 months, the Nifty EPS for a given year used to fall by 10 to 30%.
Oh.
Right? Most years it was
downgrades.
So every 3 months you would see 2 to 3% cuts. Now, so what would happen every 3 months is that you have a roll forward gain, because generally the consensus would be positive. So you would gain 3-4%, you would see a 2-3% cut. The forward earnings would be more or less stable. What has been happening the last 4 years is that those cuts have disappeared. Now, it's because financial earnings have gone up, some auto earnings have gone up, and some other cuts are still happening. But the net, the Nifty EPS is actually doing very well. And in fact, almost all of the performance, in fact, more than all the performance of the Nifty this year is because of roll forward gains in the Nifty, in the EPS.
Okay.
So I think the market is most likely to time correct. This is something that I've been talking about since September of 2021, and I think there is another year or so of that correction left. Remember that US Treasury yields are the risk-free rate for the world. And in several of your prior shows, I've also brought out this point that after the financial crisis, the US had taken a tight fiscal, loose monetary approach.
Yeah.
And therefore, progressively through the last decade, our PE multiples kept going up. Now, because that scheme didn't work, and this is the remarkable thing about the US, right? So they're not dogmatic about anything. So they're now reversed it. So they're saying, okay, so lose fiscal, tight monetary, and let's see if this works. Now, what this means for the rest of the world is that the cost of capital, the risk-free rate that we build in, has to be higher. And therefore, if you remember, 2013-14, 14 times forward was a good multiple for the Nifty. And I'm not saying we're going there because India has improved. But I would say that in 3 years' time, we would be happy with 16, 17 times forward. So I think the PE multiples need to come down, and we will still outperform because our
we are going to be around 22,000 is what you're, around 20,000 is what you're saying. Yeah.
So the thing about the current market, and for investors, I think it's very important to think through, is that there are so many variables in the air that it would be unwise to see 3 years out and say, this is what I'm going to do. Okay. Right? So there are some good companies which I think will do well. So when you're at a company level, of course, we also have very strong views on a few names. But at a market level, you have to play it like a chess game, that you make a move, let's see what happens, then you make a move, then see what happens. So what is likely to happen is that whenever the accident or whatever, whenever the stress becomes enough, like, Silicon Valley Bank failing was the catalyst for the Fed to start growing its balance sheet again. So whenever the stress becomes intense, because with 130, 140, possibly 150% of debt to GDP in the US, possibly by 2032-33, this is unsustainable.
Yes.
So you either need to get financial repression or you need to get the Fed to start buying a lot of US treasuries. And we just have to wait for that to happen. So there will be a point where it looks like things are falling apart, and then the Fed has to step in. The question is, will they step in early? Will they step in late? Will they allow some of the, at 4-5% US Treasury yields, which I think will be there for a while, a lot of the financial architecture or financial structures that have been built up over the past decade are not sustainable.
Absolutely.
So therefore, I think we have to wait to see how much of damage are they willing to allow to happen before they step in.
Before they change.
You have to take it one step at a time, but I think it's time to stay cautious.
Thank you, Neelkanth, as always, for the excellent analysis. And here's wishing you and yours a very happy Diwali. We have to take a break, and thereafter, Betty Subramaniam, the Chief Investment Officer of UTI Mutual Fund, will be with us.